So the Federal Reserve just admitted they lost the receipt for the global economy. It is apparently stuck under a couch cushion in a basement in Geneva. I am kidding, but only barely. Because if you watched what just happened on the Sunday Night Open, you would think the people running the financial system are either asleep at the wheel or actively trying to drive the car off the cliff. Sunday nights are supposed to be quiet. Sunday nights are supposed to be when the algorithms take a nap and the volume is thin and nothing happens until London wakes up. But last night was not quiet. Last night was a crime scene. But seriously, stop scrolling. Put the phone down on the table and listen to me, because what just happened in the first 15 minutes of the Sunday trading session is the single most important signal we have seen in 3 years. The chart gapped. It did not drift. It did not slide. It teleported. And that gap just told us that the $100 silver price is no longer a meme, and it is no longer a hope. It is a mathematical inevitability that has now been programmed into the plumbing of the market. Exactly what happened is this. The market opened and liquidity vanished. The price of silver was slammed down in a vacuum, then ripped higher in a vacuum and settled into a range that makes absolutely no sense unless you understand what is happening in the physical vaults. The Sunday night gap was the moment the paper market finally admitted it is terrified of Monday morning delivery requests. We are watching a system that is breaking down in real time, and the gap on the chart is just the crack in the windshield before the glass shatters. Now, quick favor before we go deeper into the plumbing. I am running a campaign to push back against the copycat channels that steal this work and dilute the message with AI-generated nonsense. If you value what I do here, hit subscribe and comment. OG John AG right now. It takes 2 seconds, and it tells the algorithm who is really riding with us. Also, I built a WhatsApp channel for daily updates and instant voice notes when the market breaks like this. The link is in the description. Join it because the market does not wait for me to upload a 30-minute video. So let's dive into the meat of this, because we have to talk about the mechanism. Most people see a price gap on Sunday, and they think it is just volatility. They think it is just low-volume noise. That is lazy analysis. In a normal market, yes, Sunday is noise, but in a market that is structurally short of physical metal, a Sunday gap is a liquidity scream. It means there were no sellers at the previous close. Think about that. The price closed on Friday, the world spun for 2 days, news happened, geopolitics happened, and when the lights turned back on, nobody was willing to sell at the Friday price. The computers had to hunt higher to find a single ounce of liquidity. This is the definition of a seller's strike, and it is happening at the exact moment the CME and the big banks are trying to tell you that silver is plentiful. They are raising margins, they are putting out bearish notes, TD Securities is telling you $40 is coming, and yet on Sunday night when the market opens, the price gaps up. Why? Because the physical market does not read bearish notes from Canadian banks. The physical market reads supply and demand. And right now the supply is in a chokehold. Let's break down the plumbing of this gap, because this is where the money is made. When you see a gap like this, it usually gets filled. That is the technical rule. Traders love to say the gap must be filled. They will short the market expecting the price to come back down to cover that empty space on the chart. And usually they are right. In a paper market, gaps get filled. But we are not in a paper market anymore. We are in a transition phase. We are moving from a paper derivative market to a physical scarcity market. And in a physical scarcity market, gaps do not get filled. They get widened. This is the trap. The smart money knows the technical traders are looking to short this gap. They are waiting for you to bet on a pullback. They want you to look at the chart and say, oh, it went up too fast on Sunday night. It has to come back down. That is the bait. Because while you are betting on the chart to fill the gap, the industrial buyers are panic buying the physical inventory that backs the chart. They are not looking at the gap. They are looking at their warehouse levels and seeing zero. We need to talk about the difference between the price you see on the screen and the price you pay in the real world, because Sunday night exposed this perfectly. While the futures market was gapping and whipping around the physical premiums in Shanghai, and the physical premiums in the Middle East did not flinch. They stayed elevated. They stayed decoupled. That means the real world price is pulling away from the paper price. The gap on the chart is just the paper market trying to sprint to catch up with reality. But that is not the scary part. The scary part is what happened to the open interest during that gap. Usually when price spikes on a Sunday, open interest drops because shorts are covering. They are panicking out of the trade. But last night, open interest actually rose. That means new money is entering the long side, even at these gap levels. It means the big players are not taking profit. They are adding to the position. They are doubling down on the thesis that the supply chain is broken. You have to understand the warehouse receipt game to understand why this $100 signal just triggered. The COMEX has 2 piles of silver, eligible and registered. Eligible is just metal sitting there. It might belong to you. It might belong to a bank. It is not for sale. It is just parking. Registered is the metal that has a warrant attached to it. It is the metal available for delivery against a futures contract. That registered pile has been bleeding out for months. It is down to levels that are historically dangerous. So when we get a Sunday night gap, what it really tells us is that the owners of the registered silver are pulling their offers. They are removing the warrants. They are moving that metal from registered to eligible, or they are loading it onto a truck and taking it out of the system entirely. When the offers disappear, the price has to gap. It has to jump over the empty space where the sellers used to be. The gap is the absence of sellers. And this brings us to the concept of the rug pull. I've told you before that the rug pull works both ways. Usually we worry about the banks pulling the rug on the longs. They smash the price to trigger stop losses. But what we saw Sunday night was a rug pull on the shorts. The shorts went home Friday thinking they were safe. They thought they had capped the price. They thought the margin hikes would cool the market down. Then Sunday night hits and the floor drops out from under their short position. The price opens higher than their stops. They are trapped. This is the mechanism of a short squeeze. It does not happen during the day when everyone is watching. It happens in the dark. It happens on Sunday night when the risk managers are at home having dinner. The gap forces the risk managers to wake up on Monday morning and panic. They have to buy to cover, and their buying fuels the next leg up. This is how you get to $100. You do not get there in a straight line. You get there in a series of violent gaps that trap the shorts and force them to become buyers. But we have to look deeper at the geopolitical trigger for this. Why now? Why this Sunday? Look at what is happening with the BRICS nations. Look at what is happening with the new gold-backed trade settlement systems. They are draining the West of physical assets. We saw reports of massive silver movements out of London and into the East. This is not a conspiracy theory. This is trade data. The East is buying the dip and the West is selling the rip. The Sunday night gap is the result of that flow. The Western paper markets are thin because the physical metal has moved east. When liquidity is thin, volatility explodes. You cannot have a stable price when the warehouse is empty. That is physics. You can print paper contracts all day long, but you cannot print a 1,000-ounce bar of silver. And the market is finally doing the math. Now I want to address the skeptics. I see the comments. People say John Silver has been manipulated for 40 years. Why would it stop now? Why is this gap any different? And that is a fair question. The difference is the inventory. For 40 years, the banks had a buffer. They had a mountain of silver they could dump on the market whenever the price got too high. They used that buffer to smash the price and scare you out. Today, that buffer is gone. The registered inventory is down to the dregs. They are scraping the bottom of the barrel. So when the price gaps on a Sunday night, they do not have the metal to dump into the rally to suppress it. They are firing blanks. The manipulation only works if you have the physical metal to back it up. When you run out of metal, the manipulation turns into a suicide mission. The shorts are naked, and the Sunday gap just turned on the lights. But here is where it gets really interesting. We have to talk about backwardation. This is a technical term, but it is simple. It means the cash price is higher than the futures price. It means people are willing to pay more to get the metal right now than to wait a month. In a normal market with storage costs, futures should be higher. Backwardation is a signal of extreme shortage. During the Sunday gap, we saw backwardation flare up in the Asian markets. The spot price in Shanghai was trading dollars above the COMEX price. That pulls the COMEX price up like a magnet. The gap wasn't just random buying, it was arbitrage bots seeing the higher price in Asia and buying the US open to close the spread. The entire global market is being dragged higher by the physical shortage in the East. This is the plumbing I keep telling you about. You cannot analyze silver by looking at a chart of the US dollar. You have to look at the spread between London and Shanghai. You have to look at the lease rates. You have to look at the warehouse movements. The Sunday gap was a symptom of a broken plumbing system. The pipes are leaking and the pressure is building. And think about the timing. This gap happened right after a major margin hike. The CME raised margins to try and stop the rally. They tried to make it too expensive for you to hold contracts. And what did the market do? It gapped higher. That is the ultimate sign of strength. When the referee changes the rules to help the other team, and your team still scores a goal, that is when you know you are winning. The margin hike failed. The intimidation failed. The gap is the market's middle finger to the regulators. But that is not the scary part. The scary part is what happened next. After the gap, the price did not collapse. It held. It consolidated. That tells you the buyers are not speculators. They are accumulators. Speculators take profit after a gap. Accumulators buy the gap, and then they sit on it. They take delivery. They remove the metal. This behavior is what confirms the $100 signal. Let's talk about that $100 signal. Why $100? Why not $50 or $75? Because $100 is the level where the media can no longer ignore it. $100 is the level where the average person on the street asks their financial advisor why they don't own any. $100 is the viral event. The Sunday Gap is the ignition sequence for that event. It shows that the price can move $5 or $10 in a vacuum. Once we clear $50, the air is thin. There is no resistance. The move from $50 to $100 will happen faster than the move from $20 to $30. We are watching a kinetic event. The Sunday Gap was the sound of the engine starting. And the passengers, that's you and me, we need to be strapped in because the volatility is going to break people. The banks are not going to give up easily. They will try to smash it again. They will try to fill the gap. They will use every trick in the book. But the physics are against them. You have to remember who is on the other side of this trade. It is not just us stackers. It is China. It is Russia. It is India. It is the solar industry. It is the EV industry. They are all competing for the same shrinking pile of silver. And on Sunday night, they decided they were not waiting for Monday. They hit the bid. They cleared the order book. And let's go back to the industrial aspect for a second. These companies operate on just-in-time delivery. They do not hold massive inventories. They trust the market to deliver the silver when they need it. The Sunday Gap terrified them. It told them that liquidity is not guaranteed. It told them that price can jump 10% while they are sleeping. This forces them to change their strategy. They have to move from just-in-time to just-in-case. Just-in-case buying is what creates a super spike. It means Samsung and Apple and Tesla start buying silver months in advance. They start hoarding. They start front-running each other. When industrial users start hoarding, the price becomes irrelevant. They will pay any price to keep the factory running. A $5 rise in silver adds pennies to the cost of an iPhone. They do not care about the price. They care about availability. The Sunday Gap signaled that availability is the problem. So when I say stop everything, I mean stop looking at silver as a trade. Stop looking at it as a way to make a quick buck. Start looking at it as a strategic asset that is disappearing. The Sunday Gap was a warning shot. It was the market telling you that the window to acquire physical metal at these prices is closing. The volatility is not a bug. It is a feature of a breaking market. Think about the psychology of the gap. It creates FOMO, fear of missing out, but it also creates FOLS, fear of losing supply. That is a much stronger emotion. When a refiner sees that gap, they panic. They realize they might not be able to source the metal they need to fulfill their contracts. So they bid higher. They chase the price. This creates a feedback loop. The higher the price goes, the more they panic buy. The Sunday Gap started that loop. We also need to discuss the mining side. Miners are not selling into this rally. They are holding back supply. They know the price is too low. They are facing higher energy costs, higher labor costs. They are not going to flood the market just because the price gapped on a Sunday. Supply is inelastic. Demand is parabolic, and the gap is the result. And do not forget the geopolitical layer. We have wars in Europe and the Middle East. We have tensions in the South China Sea. In times of war, silver is a strategic metal. It is used in missiles. It is used in satellites. It is used in communications. Governments are quietly stockpiling. Do you think the U.S. government is going to announce they are buying silver? No, they do it quietly. They do it through intermediaries. They do it on Sunday nights. The gap we saw could very well be a sovereign buyer stepping in, a large entity that needed to move a massive amount of cash into hard assets before the markets opened on Monday. It smells like a sovereign move. It smells like a panic bid from a nation state that sees the dollar crumbling. Which brings us to the currency aspect. The dollar index is looking shaky. The bond market is screaming. Yields are spiking. This means the cost of debt is rising. The U.S. government is trapped in a debt spiral. They have to print money to pay the interest. Printing money debases the currency. Silver is the anti-dollar. The Sunday Gap was a vote of no confidence in the fiat currency system. It is all connected. The gap, the inventory drain, the margin hikes, the geopolitical tension. It is one massive story pointing to one inevitable conclusion. Silver has to reprice. It has to go to a level that balances the physical supply with the paper demand. And that level is not $30. It is not $50. It is substantially higher. The $100 signal is flashing red. And let's talk about the retail investor, the little guy, you, me. The Sunday Gap is designed to shake you out. They want you to see the volatility and get scared. They want you to sell your stack because you think it is too risky. Do not fall for it. The volatility is the turbulence you feel when the rocket takes off. You do not jump out of the rocket because it is shaking. You hold on tighter. I want to emphasize the registered inventory one more time because I cannot stress enough how critical this is. We are seeing days where millions of ounces leave the vault in a single session. If that pace continues, we are looking at a vault default in months, not years. A vault default is the end game. It is when A contract holder shows up with their warrant and the exchange says, sorry, we don't have the metal here, is a check. That is force majeure. When force majeure happens, the price of silver goes to infinity. Not literally infinity, but it goes to a number that accounts for the fact that you cannot get it. The paper market dies. The physical market takes over. The Sunday gap was a preview of that death. It was the paper market glitching because it lost its tether to reality. We are also seeing the spread between silver and gold tighten. The gold-silver ratio is dropping. This is classic bull market behavior. Silver leads gold in the late stages. The Sunday gap saw silver outperforming gold. That is a leadership signal. It tells us that the speculation and the industrial panic are flowing into silver first. But that is not the scary part. The scary part is what happened next. After the gap stabilized, we saw the banks trying to paint the tape. They tried to walk the price down during the London fix, but the buyers were there. Every dip was bought. This is new behavior. Usually the banks can smash the price at will. Now they are hitting a wall of buying. The wall is made of physical demand. So what do? We watch the open, we watch the close, we watch the volume. But mostly we watch the premiums. If the price on the screen drops, but the premium at your local coin shop goes up, that is the signal. That is the divergence. The Sunday gap widened that divergence. It showed us that the paper price is broken. We are 20 minutes into this rant, and I hope you are starting to see the picture. This is not about a daily candle. This is about the end of an era. The era of manipulated paper prices is ending. The era of physical price discovery is beginning. The transition will be messy. It will be violent. There will be gaps. There will be halts. There will be rule changes. They will try to change the rules of the game because they are losing. They will raise margins again. They will limit position sizes. They might even try to ban private ownership or tax it into oblivion, but they cannot stop the math. The math says there is not enough silver. The Sunday gap was the market doing the math. Now I want to zoom out and connect this to the macro picture, because you cannot trade silver in a vacuum. The Sunday night gap is not just about silver, it is about the end of the dollar. We are watching the bond market vomit. We are watching yields spike, which means the value of the collateral backing. The entire financial system is collapsing. When the collateral fails, the margin calls go out. And when margin calls go out, people sell what they can to save what they must. But this time they are not selling silver, they are buying it. This is a fundamental shift in behavior. In 2008, when the system cracked, gold and silver sold off initially because people needed cash. This time silver gapped up. That tells you that silver is no longer just an asset, it is the liquidity of last resort. It is the safe haven. The market is sniffing out a total reset. A reset where paper promises are worthless and only bearer assets matter. You have to understand the fear of missing out that is building in the institutional world. These fund managers are not stupid. They see the inflation, they see the debt, they see the Sunday gap. They know they have zero exposure to commodities. They are sitting in tech stocks and government bonds. If even 1% of that capital rotates into silver, the price goes vertical. The Sunday gap was the first trickle of that rotation. This is risk management. It is not speculation. Buying silver at these levels after a gap is not chasing. It is securing insurance before the house burns down. The gap is the smoke. The fire is coming. You do not wait until you see the flames to buy a fire extinguisher. You buy it when you smell the smoke. We smell the smoke. And let's talk about the war cycle. History tells us that in times of total conflict, fiat currencies die. Every single time. From Rome to Weimar to today, we are entering a cycle of conflict. The Sunday gap is a war drum. It is the market pricing in chaos. Silver is the currency of chaos. It has no counterparty risk. It does not rely on a SWIFT system or a power grid. It is wealth in your hand. The banks know this. That is why they are net long now. Look at the COT reports. The commercial banks have reduced their short positions. They are flipping. They are getting ready to ride the wave up. They are setting the trap for the retail shorts. The Sunday gap was the banks squeezing the last weak hands out of the market so they can let it run. We are looking at a wealth transfer, a massive transfer of wealth from those who hold paper to those who hold real assets. The Sunday gap was the opening bell for that transfer. If you are holding paper, you are the yield. You are the liquidity. If you are holding silver, you are the bank. So what happens next? We are going to see more gaps. We are going to see days where the market opens limit up. We are going to see days where you cannot buy silver at any price. The dealers will simply say sold out. The websites will crash. The phones will not be answered. The Sunday gap was a polite warning. The next one will not be polite. The next move won't be polite. It will be a face ripper. It will leave the skeptics in the dust. It will destroy the portfolios of the unprepared. You have to decide right now which side of history you want to be on. Do you want to be the person explaining why you didn't buy when the gap signaled the move, or do you want to be the person sitting on a stack watching the world panic? This is the doom and glory close. The doom is for the dollar. The doom is for the paper system. The glory is for the stackers. The glory is for the people who endured the smashes, who ignored the noise, who held the line. The Sunday gap was your validation. It was the market telling you that you were right all along. But do not get cocky. The fight is not over. They will attack again. They will try to shake you loose. They will weaponize the media against you. You have to stay resolved. You have to trust the plumbing, not the pundits. The plumbing is screaming shortage. The gap is the evidence. So here's the bottom line. The Sunday night gap triggered a $100 signal. It exposed the lack of liquidity. It exposed the physical shortage. It exposed the desperation of the shorts. It is a one-way ticket to higher prices. The train has left the station. If you are not on board, you are running out of time. I want you to check your position. Check your physical holdings. Do not trust the ETFs. Do not trust the unallocated accounts. If you cannot hold it, you do not own it. The Sunday gap proved that paper promises can evaporate in seconds. Real metal does not evaporate. This is the time to be aggressive. This is the time to finish your stack. Do not wait for a pullback that might never come. Do not wait for the gap to fill. The gap is the new floor. We are building a new reality on top of it. The next few weeks are going to be critical. We will see if the $100 signal confirms. We will see if the industrial panic sets in. We will see if the banks flip fully long. Watch the open interest. Watch the warehouse drawdowns. Watch the premiums. Ignore the noise. Focus on the signal. The signal is loud and clear. Stop everything. Pay attention. The game has changed. The rules have been rewritten, and the silver market is never going to be the same again. I'm John OG. Comment OG, John OG if you are still here. Fight the copycats. Stay safe. Keep stacking. And I'll see you in the next one.